So good evening and good afternoon to those who are in an earlier time zone. So welcome to this webinar. I'm delighted to be speaking on QR payments in Africa. So Deepak, I hope you can hear me. Just raise your hand if you can.
Yes.
Yeah, all right, perfect. Thanks. So we started Nearex, and with the focus of delivering payments within Africa. And we have been seeing the payment market evolve in Africa. We have seen the ecosystem supporting payments evolve, and we have been keeping pace with what's happening in that market. QR is a perfect opportunity at the moment, and I'm glad that this particular webinar series is going to be on. This particular webinar is going to be on QR payments. So before I jump into the actual presentation, I want to just let you know, in case you have any questions, feel free to ask those questions on the Q&A box, and I'll be happy to take them up as once I'm done with this initial presentation. So I will switch to the presentation. Hopefully you should be seeing the presentation now. Before I jump into payments using QR proper, I just want to take a minute on QR itself. At the heart of QR, it's a very simple technology, right? It's absolutely trivial in what it actually does, and yet it has transformed payments so much. In fact, I guess it's a hallmark of all technologies that they have to be really simple for them to be adopted at scale. So if you see QR technology and how it works, you see this this box here called the text information, and let me see if I can point out that. Yes. So you'll see this box here, the text information, and it's really taking that piece of text, and that could be anything. It could be a number, it could be a name, it could be amount, and convert into a QR pattern. That's a QR generation process. And a scanner would scan that and then convert it back into that number. At the heart of QR, it's really just that. Take text, convert into an image, and have someone scan that image and generate text back. So it really replaces typing. And yet, with all its simplicity, it has really made a huge difference to payments. So what makes QR really that good for payments? The first is it can hold a lot of information. So while my example here is just a few digits, it can actually pack thousands of characters as well. Even though most payments don't normally use that, it can hold a lot of information. Second, and I think it's the most important characteristic of QR, is that it's heavily resistant to dirt, damages, and in general, damages that can change the way the QR is seen. So it can be as simple a thing as this red line running through the QR. It could be a portion of it actually moved out, or sometimes it's intentionally done. You can see a logo on top of a QR, and that's really intentional damage done to a QR. And yet a QR scanner can handle all of those and can get a good recognition rate out of them. The third, and this is good from a usability point of view, is that it can be read in any direction. So these three these detection patterns here, these three squares at the end of these QR, those are the key things in making sure that you can read this from any angle. And because it's so versatile, you can hold it upside down, you can read from a distance, all of them still work well, and it generates a great recognition and reliability. In payments, more than anything else, what you need is good reliability, and this works excellently. So given those features of QR, it's not a surprise that it has been used for a very large number of applications. Payments is certainly one of them, but there are plenty more. Operations, logistics, product tracking, information sharing, everything is there in using QR as a basis. So let's now start looking at what makes payments using QR particularly good. The first and the most important aspect of QR payments is that it achieves a payment infrastructure with extremely low cost, right? And this is because it doesn't need terminals, it doesn't need cards with the customers in order to achieve a payment ecosystem. The fact that you don't need hardware of any kind, and it can be used as pure apps running on either the merchant's own phone or the customer's phone, makes it an extremely affordable solution and something which is easy to roll out in a lot of markets. In today's world, having a payment system that's truly contactless is a welcome thing, right? So unlike even regular contactless cards or something, here a contactless is genuinely contactless. It could be a few inches or few feet of space between the customer and the merchant, and that's a great thing in these Corona times. A few other things which are a natural consequence of it being a app first or app only payment system is that you can manage almost everything remotely. Right? So those who have tried payments know that cost of acquiring merchants or customers is tremendous, where you need to distribute cards or terminals. And if it changes into a pure app-based model of doing things, then certainly you can reduce the cost of acquiring and you can manage most things remotely. And that's a huge saving in cost, and leading to much better and effective rollouts. And because there's no hardware, there's no charge slip, so it all makes sense from that point of view. QR payments are not new. I mean, they've been around for a while. They've been at least a decade old in China and in other markets. Even in Africa, it's not like QR doesn't exist today. If you see the map, there are quite a few markets where QR is being used today. It's just that it's not in a particularly, in some cases it's organized, there are standards coming up around that. In some cases it's different parties who are doing QR-based payments. So there's a cluster of different services being run. And if you see here, in many countries there are multiple services being run. And South Africa has 26 million users today, which is a substantial number. And Egypt, has about 40 odd million. So substantial number of QR code users today. But when you see that each country has multiple different service providers, you will realize that, and not all of them are actually connected together to make a unified whole. So you can, customers belonging to one QR service can pay others and so on. Once you start seeing that, you'll realize why a unified QR becomes necessary. And that's sort of the basis for this talk today. One of the things that naturally comes up when you look at a completely app-based payment system is the penetration of smartphones in Africa. And clearly, smartphone penetration has increased dramatically over the last few years. And it's reached maybe 40 to 50% across all of Africa. And in some countries, it's definitely much larger, while in some other countries, it's a little behind. But with average of 40, 50% of smartphone penetration, that's quite a bit. You might consider that 40, 50% is not adequate, but if you really see the total number of digital payment adopters, or the initial adopters particularly, you will probably find that more than 90% or even 100% of those users are already smartphone users. So they are a great demographic to start a QR-based payment system without necessarily waiting for the penetration to go into the 80s or 90s across the whole of the population. So let's take a look at a very basic payment transaction, right? The absolute minimum that you would be having. So this is a payment. What you need is a customer identifier, who's making the payment, the merchant identifier, who is receiving the payment, the amount being transacted, and some kind of authorization to say that it's the right customer doing the right transaction, and so on. Now, if you take each of these different parameters, which are at the heart of what a payment transaction is, and then convert different bits to a QR, you'll get different modes of QR payment. And that's how a QR payment can be studied. So if you take a customer identifier and convert that into a QR, like here, what you get is a customer presented mode of making QR payment. If you take the merchant identifier and convert that into QR, then what you get is a merchant presented static QR mode. If you take both the merchant identifier and the amount, these two bits here, and then convert that into QR, what you get is a merchant presented dynamic QR mode. Authorization is fortunately outside QR at the moment. There are some experiments actually where you can have a QR embed a biometric details, and you can actually scan your photograph as well and make that payment. But that's not really in the market yet. It's just experiments, I would imagine. So depending on what of these three basic payment parameters get converted into QR, you get three different fundamental modes of making payments happen. That's really the essence of QR. So let's look a little bit deeper look at what each of these different modes mean. Let's start with the customer presented mode. If you recollect from the previous slide, this is the mode where a customer identifier is converted into a QR code. So this is usually done by an app the customer carries, so the customer signs up with a QR service provider, gets an app that will allow the customer to get a QR identifier. Now, once the customer generates a QR, the merchant would need to scan this via POS terminal. This could be a regular POS terminal, it could be a billing system like you would find at a supermarket, or it could be a smartphone that the merchant is using. Right? So a smartphone camera is perfectly adequate to scan a QR code, even in the merchant's hands. but it still needs the merchant to have some kind of a scanning device. And the merchant initiates the transaction, the merchant sends out the request to their acquiring bank or the telco, whoever is providing the backend service, and then the transaction gets completed via the customer's own app for authorization. So that's how a customer presented mode normally works. The thing to note about the customer presented mode is that the customer needs to generate a QR first. And for security reasons, usually it has to be a dynamic QR. And because of that, the customer needs connectivity. Though it can work with static QR in some exceptional cases, the merchant is the one who initiates the transaction and needs connectivity as well. So in this customer presented mode of QR-based payment, you end up having to have a smartphone on both sides of the ecosystem. The transaction, the customer has to have a smartphone, the merchant needs one as well. In the merchant presented mode, the merchant can have a simple QR, which could be just a sticker, a placard, or something you stick on your counter or place it next to your products, and you are pretty much ready to go. The merchant doesn't need to have a smartphone. A merchant could have just a feature phone and receive a payment confirmation on that and fulfill the transaction. So in this mode, the merchant makes the QR code visible to their customers. The customers use their own app provided by the QR service provider again, and then scans the merchant QR and sends the transaction directly from the merchant's own, the customer's own phone. So the merchant is really a passive participant in this transaction, but when the payment is done, the merchant receives a notification. This could either come as an app notification on a smartphone if the merchant has one, or just a plain SMS on the feature phones. So the merchant gets confirmation and can make the payment happen. This, as you can imagine, is super low cost and doesn't need the merchant to have connectivity at all. So it works great for really small merchants or even hawkers who maybe own mobile, and they can just set up a placard and be ready to start accepting QR payments. So these are the two broad payment modes that are in vogue around the world, and we can talk in more about these things. For the rest of the presentation, I'll be focusing primarily around merchant presented mode, because the mechanics are very similar to the other one as well. But given the much larger deployment and the interest in merchant presented mode, I'll focus on that in the next few slides. So this whole mechanism where a customer makes a payment to a merchant is called a push payment, right? It's being initiated by the customer. The merchant is a passive participant. For most people in Africa, this is really not a new thing. I mean, there have been many deployments using USSD-based till payments, right? There's the till ID stuck on a wall behind the merchant. The customer initiates a payment. So that has been a push payment. But clearly, we know that there are difficulties and challenges in user experience, in the number of steps involved in making that payment happen and so on, which like I was describing in the very first slide, it simplifies all of those things because you don't need to enter that much input and hence makes things happen much more smoothly. But push payment comes with a few other good attributes, which I think are worth mentioning. First is that the customer retains control all through the payment process. What it means is that there is a much larger amount of trust that the customer have on the system. They can rely that there is no fraudulent transaction taking place by someone accessing their QR code or whatever. It's all being done by them, and that gives a much higher trust, which is important in today's world where smartphones are seen as devices which can be hacked and so on. By giving the control completely in the customer's hands, you do a really good job of ensuring trust there. The second is a consequence of that. This merchant does not get to handle customer credentials. They don't need to get customer card numbers or bank account details or anything else, and which means that the merchant capabilities need to be much more simpler. They don't need to handle sensitive data. There's no a question of them having to worry about PII and so on. Those who will come from a banking background will understand the sensitivity around that. So all the merchant does is get notification that the payment has gone through, and that makes it very easy to onboard a very wide variety of merchants. Right, so merchants who may not qualify for a conventional EMV card terminal can then qualify for this because of the simplicity of the onboarding, and apart from the cost involved. The third is low-cost equipment. We already talked about that. Just a sticker is good enough, though for other merchants, you might want to have an app or some kind of a digitized system which will generate those QR codes. Also equally convenient for merchants is that you don't really have failed transactions going to the merchant. Right now, this makes it so much more easier for a merchant to manage. There's no question of having to think about how to refund these transactions in case some things are failed or failing settlement and so on. So if a transaction reaches a merchant, then it means it succeeded. So pretty much no failed transactions reach in this kind of a model. And clearly it works with both static and dynamic QR, which makes it pretty comprehensive. The ability to work with dynamic makes it suitable in many different ways, and I will cover that next. In a static QR, like the one you see here, all it contains is really just a merchant identifier. You don't need more than that for making the transaction happen, as you saw in the earlier slide. So it could be done as a sticker or a placard, and you could mass produce these, from a service provider point of view. You could mass produce these stickers and then distribute them and just associate a particular ID with a particular merchant on the back end, and you're pretty much done. So that's a very simple and effective way of rolling out a static QR. But this does require the customer to enter in the amount and kind of do the transaction, which is good in many cases, but can be cumbersome if it is in a more higher traffic environment like a supermarket. So there, a dynamic QR can work much better. What the dynamic QR does is contain more information. If you see this section here, it has ID, the one as in the previous one. It has amount, it has some kind of a order ID or bill number or invoice number or whatever is the tracking information that the merchant wants to include in the QR. And then there's the name of the merchant itself. As you can see, this is a little bit more sparser, the QR, while this is a little bit more denser because there's more information packed in that. Now, when a customer scans this, the customer gets all the information packaged. If they see the name of the merchant, they see the amount that's to be paid, and they can go ahead and make that payment. It's a complete confidence that they're doing the right kind of transaction. So it's safer, the customers make less mistakes. There's no ambiguity of how much a customer is paying. The merchant doesn't need to look at the SMS to figure out what is the amount that has been paid by the customer. If a dynamic QR is scanned, then the amount paid would be exactly matching the amount the merchant intended to get. It's faster because you have less manual steps to be performed by the customer, and merchants know exactly how to operate these terminals, but customers may not be doing it as often. So it makes it so much more simpler. And because there is a presence of a order ID or an invoice ID as part of the transaction, it makes it easier for larger merchants to reconcile with settlements and so on, and make it a more robust system overall. So that's how the static and dynamic QR differentiate, but they are all equally usable. It's not like you would want to use one or the other. Most often you would have both systems working in parallel. The dynamic QR comes in handy in a couple of other situations, and it would be amiss of me if I don't talk about that. The first is in completely passive infrastructure. For example, utility bills. If there's a utility company which is sending out bills for postpaid payment or something, and they print a formatted dynamic QR. Dynamic in the sense is that it's customized per bill rather than a single one which goes on all bills. So it's a custom generated QR that goes on each one of these, that the customer can just scan that QR and make a payment. They don't actually have to go and go anywhere else other than just look at the piece of paper and initiate a payment right there. It can be present on restaurant bills. So if a bill contains a QR at the end for the amount for that particular bill, then again, the patron just needs to scan that bill and then make the payment and be done with it. You don't need to really go and have someone interact with that patron to get a payment done. And vending machines are a great example because they have to be dynamic in the sense that when you pick a particular product and each product varies and has a different price in the vending machine, you would want to have that particular dynamic QR pop up. The customer can scan that and the payment gets done. So that's a great example of where dynamic QR is absolutely the right thing to use. It's also used in online portals. In many cases on online portals, you can have multiple options, but a dynamic QR is a perfectly acceptable way of making a payment happen in online portals too. So when you go to the checkout page, you would show the QR containing all the information that your site needs to reconcile and for the payment to go through. The customer can actually scan a online portal through the checkout page through their phone and make the payment and be done with it. So all very effective users of dynamic portal can make payment so much more simpler the way you roll it out. With that background and context on how QR payments work, the difference between customer presented, merchant presented, as well as dynamic and static QR and the applications, let's start looking at what unified QR is. That's the crux of what we are going to be talking about today. So why is unified QR even an important thing to consider? Now, payments are what are called as a two-sided platform, right? It means you need to get merchants on one end, you need to get customers on the other end, and you need to make them interact in some way at a physical retail location or some other physical place in order to make the transaction happen. It could be in a virtual location where you need to get the customer to your portal and make the transaction happen. But regardless, you are a payment service provider is actually getting two independent parties together, and that's a tricky problem in general, regardless of which domain it is. If a taxi company has to get drivers on one end and passengers on the other end, it's a very similar two-sided problem, and not everybody can make that happen. So when someone launches a payment system, they have to go acquire the merchants, they go and acquire the customers, and then they make them transact. The more such players exist, the more fragmented the ecosystem becomes, right? So you have different small ecosystems getting created, each with their few set of merchants and a few customers that they acquire. It's quite possible that they actually have the same overlapping set of customers because that's the demographic which is actually looking at digital payments. But then you get a graph which sort of looks like this, all disjoint, fragmented ecosystems. And we know that the number of interactions possible increase exponentially when you can club all of those customers into one bucket and all the merchants in one bucket. So it just shoots up the number of interactions possible, which means that transactions will grow enormously as well. So the right way to look at payments, QR or any other for that matter, but in this context, QR, is that you try and unify all the different systems into one consolidated whole, and that will actually help trigger payments in a given market or country. So EMV is an example of something like that. EMV has been existing for a while now. You go and acquire merchants using the EMV card network, and anybody else in that market or from somewhere else who carries a scheme card like a MasterCard or a Visa can go and make a payment at that merchant. You don't need to go and acquire all the customers. Similarly, as the issuing side entity, if you issue cards with a MasterCard or Visa, you don't need to go and actually sign up all of those merchants because you know that all the existing merchants can accept your cards as well. But you need to get something equivalent on the QR side. And that comes in by someone playing the role of that unifying entity that's being played by schemes elsewhere. QR, because of its simplicity, has actually created a large number of such opportunities, and yet the fragmentation can hold everybody back. And we think that by looking at unification as a goal right at the very beginning and adopting both business models and technical solutions which will support that, you can make go a long way in making a successful payment ecosystem in a country. Before I get into the actual models of unification, I just want to let you know that unified QR goes by a variety of different names: harmonized QR, standardized QR, single, one, unified. I mean, all are exactly the same thing. It's really just getting all parties in a QR ecosystem to agree on something common, and so that you don't have to replicate the efforts of each other. That's the essence of it. So before we get into the how unification can be actually achieved, let's take a look at a few countries where the QR has been either hugely successful or getting there, and see what we can take away from there. So China is the poster boy of QR payments, and WeChat Pay and Alipay are the absolute reigning duopoly of QR payments in China, and they're huge so that they overshadow everything else in the world. In China, there are two independent systems. There's the WeChat Pay and there's Alipay, and customers end up having both of those things for different reasons. So they started life in different ecosystems in communication or chat, and the other one in commerce, but then they started doing common payment kind of infrastructure, and so people ended up having both of those. Since both of them have nearly 1 billion users, it's basically everybody in China has both, and hence there is really not a great need to unify them. So they continue to work as two parallel ecosystems, and it's a duopoly of sorts. And China has moved a huge distance on QR. They are the first to get this going almost a decade ago. And today, 85% of consumers in China have made a QR payment. That's enormous. Pretty much, all willing customers have made a payment. Most customers end up making 3 QR payments a day. That's huge, right? That's the kind of opportunity that we should see in every single market. As a consumer, you yourself would be making more than 3 purchases in every single day, right? But you probably use a lot of different instruments. Maybe a lot of them are cash when you make those 3 transactions. So if all those transactions get converted into QR, there's no reason why all markets cannot have the same level of QR usage as in China. But in fact, the concerns right now have gone a little bit beyond making it successful. Are these duopoly too big to fail? Are they become kind of the ones who dictate terms to the government and everywhere else? So there are different concerns emerging on that, but that's a whole different story. But I think the best way to see how QR is working in China is to look at this graph here. So there's a recent survey where people were asked how long they could survive on 100 yuan, and that's about $15, $16 or so, right? So not a whole lot of cash. So if they had only that much cash, how long could they survive using just digital payments, right? So there are quite a few people who said that they could survive for more than a month, and many who are in the 1 to 4 weeks category. So if you see, there's no exact number here, but it looks like about 15 to 17% of consumers say they can survive more than a month on just $15 in cash with them. That's the kind of comfort that consumers have reached in China, and I think that's the direction which everybody is heading into. Before I jump in, I don't know if just share a poll. If you had the same about $10 in cash, how much do you think? How many days do you think you could live comfortably, right? I'm not talking about stretching yourself, but in a normal life, how long do you think you would be able to spend? So if you get a chance, respond to that question, that will be useful. I had tried a very similar thing in India about a month and a half ago. And the response I got was between 2 to 3 days in about equivalent of $10 of cash. So it's hugely, there's a huge gap between where we can get to and where India is right now. So the responses I see is, I see about a quarter, actually, no, I would say about 45% are between 1 day and 2 to 4 days. And there are another quarter who are more than a month. So that's amazing. So you must be in a place where QR codes are already, or other digital forms of payments are doing extremely well. So that's great to know. But there's a pretty wide mix, and I'm hoping that as we go along, you'll see how we can reach the levels of China's penetration for each of your countries as well. So let's have a quick look at India, because that's been a relatively more recent entrant, and it's actually had an interesting journey, and that has lessons which we can take away from when we go into the unification model. It's just a few-year-old story here of QR payments. We started with a single or proprietary QR system, which was quite widely used. Then I think over the next 12 months, there probably were 12 to 15 different QR-based payment systems. And I personally have seen, and many people in India would have seen, the shops with between 8 to 10 different QR, all different QRs stuck on their products or on their counter, all jostling for space, and you had to pick the right QR to make the payment. If you pick the wrong one, it wouldn't go through, because each of those QRs were paired with their own specific apps. And you have to allocate money to each of them independently, and you have to make the right choice of which one you want to use, because the particular merchant that you go to may have all the other 7 or 10 QR, but not the one you are interested in. So quite complex. Then came the Bharat QR standards, which try to unify all of these into a common framework which everybody could follow. And since UPI had kind of launched in the meantime, and for those of you who know UPI, it's been a game changer in the digital payment space here. QR based on UPI merged with Bharat QR has been the the model, go-to model in India in the recent past, and that's working extremely well. So there's an integrated standard which is now common across the country. So you could have just one QR at a shop, and regardless of where the the customer gets their QR service app from, you could still make a payment and it will go to the same bank account of that particular merchant. So excellent system that's running in India at the moment. As I think a precautionary measure to avoid the kind of duopoly kind of restrictions that China has had. So there's a regulation that there cannot be more than 30% of market share by any one of those players. There are large ones like Google Pay and others who are getting a little bit more than that at the moment. So the idea, I think, is to get at least 3 or 4 different players in the space. So that's how the unified QR regulation is heading there. The similar attempts in other places. Singapore launched SGQR. They currently have about 160,000 merchants, and pretty much all the banks and issuers there, I think 20 odd of them have started issuing apps which can accept SGQR. So doing quite well. Tanzania has taken a slightly different road. While it's regulated in a way, it's really MasterCard's proprietary QR or MasterPass QR, which is being used as the basis for all transactions there. It's got about 500,000 users and growing strong. South Africa has multiple different QR infrastructure, and wherever there's some unification, it's done through MasterPass, which is kind of the single largest player in Africa for QR at the moment. And there's a good number of users with 26 million users actively using QR. Ghana has launched an extremely interesting experiment around a unified QR done in a proper regulated manner. It's still early days, but I think that should go a really long way in showing what can be achieved in an African market with a unified QR. There's been a standard EMV QR that has tended to determine what standards get used or what standards get used as a basis for a national standard. So EMV QR, unlike in the EMV card space, has been a basis to derive your real standard from. So if you see this list of different QR standards across the country, across the world, you'll find there's a wide mix of them. China uses their own proprietary standards, and the MPM and CPM are the merchant presented and the customer presented modes that we talked about earlier. In all markets, merchant presented mode is certainly supported, and in a few, customer presented as well, which is why we're focusing on the merchant presented in this one. The Bharat QR of India is based on EMV. SGQR is based again on EMV. Hong Kong is based on EMV. Many other countries, wherever the standards are getting created today, are using EMV as the basis to derive a specific national QR standard, which will then become the basis for adoption within that country. So EMV QR as a base for a national standard is a great way to do things. Now, having looked at what standards exist and what the journey of the other countries have been, let's look at what are the ways to achieve unification. Broadly, 3 models we think which are which you can consider as the way to get about unification of QR. The first is mutual acceptance. The second is aggregated model of QR unification, and then third is a regulated one. Let's look at these 3 and then see what differs among each of them and what works well and what doesn't. Before we jump into each of those specific ones, there's a quick primer on how the QR itself works. So first, the merchant has to acquire a QR. Typically, it's linked to a bank account or a mobile wallet or something, a store of funds in general. Then the customer gets an app, which is linked to a store of funds or a wallet or a bank account or whatever. And so there's a linkage there. Once they have acquired their independent elements, the QR code and the app, then they're ready to transact. The customer scans the QR, initiates a payment request to the entity which provided them their app, the store of funds or the bank account or wallet. That would then talk to the merchant, which would then result in a notification. That's sort of the loop which we see. This is pretty straightforward, and the reason I'm showing this is because you'll see a more complex variations of this in the next few slides. Right, so this is pretty straightforward, and I'll skip past this. Looking at the mutual acceptance model of unification of QR, what it means is if there's a market in which there are, let's say, 2 or maybe 3 players who are all having QR payments, each are isolated and independent of each other, then this could be a model that is used to unify them. So a merchant can be acquired by either party. So party A or scheme A in the local context and scheme B can both acquire a given merchant, and they have their own apps, their own QR codes, and all you need to do is just work with each other and get each other's apps to recognize the QR of the other party, and then you would send the request to your own backend system, and then there's a backend integration to make it happen. All perfectly achievable. There's really no great complexity from making this happen, and but there are a few pros and cons of this, and we can see that. First, because it's just two parties working together, the business arrangements are straightforward enough, and the integration is fairly modest as well. So you need the apps to support each other's QR, so that if there's a merchant which has been acquired by only one party, your app can, and that happens to be the other party, then your app can still scan that and get the transaction to happen. And the notification of confirmation go all the way to the merchant. So that kind of is the integration required. Pretty straightforward stuff. But the problems with this, and while it can be used in limited circumstances, the problem really comes in when you want to scale it up. If there are more than two parties, or you want to add a new party at a later point, integration becomes extremely cumbersome and complex because everybody is talking to everybody else, and it just becomes a very poorly scalable solution. It needs every app to update to support everybody else's QR, and that's a continuous process. And you never really know, as a customer, whether that particular QR is going to get scanned or not, because you may have an app which is not current or so on. And because everybody is doing their own merchant acquisition and customer acquisition, you kind of have a lot of overlapping and wasted efforts overall. So this works still for those markets where there are two clearly defined players and they want to work with each other. It works great. The second is the aggregated model of unification. In this, there is a slightly different model. The parties A and B here, the ones in blue and green here, they acquire their own customers, right? So they manage the bank accounts or the wallets. They could be banks, they could be telcos, they could be someone else who is an independent wallet provider. They provide a app to the customer, or they could work with the entity in the orange here and provide a app which will do the job for them. All the merchant aggregation is done by a common entity. So this becomes sort of the merchant aggregator for the market, and all the other parties, the A and B, they will become the issuing partners. Now, this kind of arrangement has the simplicity that regardless of which is the customer that's approaching a merchant and belonging to either A or B, you can still get that transaction to go through. So the way this works is, the customer scans the merchant's QR, makes a transaction request to their own wallet, which will send it to that central entity. And this can result in a very scalable solution, because regardless of the number of A and B parties, or you can have C and D and D, they can all just need to connect to that one single central entity, and you're pretty much done. So the integration requirements are no different than in the previous case, and yet you can scale to a large number of participants, and hence it can be a very effective way from an integration point of view. It can influence future standardization. Eventually, every market will have a regulated standard, right? And that's kind of I would say, given, or at least the direction which all these countries would be heading. So if there is an aggregated system which is a significant market share, then that can influence future standardization and can potentially become the standard itself. Having such a arrangement is a great thing for any aggregator or set of QR players to try. Because there is a entity which is focused on merchant acquisition, they can drive transactions, and it can actually make it work much better than someone who's overlapping with everybody else, which will lead to more efficient acquisition strategies and so on. And they can eventually layer non-QR acceptance on top of the QR as well. And that makes it a very effective model. There's not really too many drawbacks. And in case there are multiple aggregators, they can connect with each other and be done. The third one is the regulated model. This is kind of the end goal of QR unification. There is a standards body which defines and says that everybody has to support this, whether it's acquirer or issuer of the QR system. A single merchant could potentially have two different QR systems, and yet without any specific integration with C and D, there's no connection between A and C or B and D, and they can still make all of this happen. The standards body would define how the QR would get presented. Each merchant would acquire and create a QR which would be read by everybody else. The individual issuers, the ones who provide the app to the consumers, they can read this and then send the request to the app. So the central standard setting body will also have to play the role of a switch in this particular case, and then it can route all the transactions effectively. So this is sort of the unified through regulation model. Now this is the end goal, but it will take a while to reach because it's an ideal state of affairs, and it can scale extremely well. It can bring in economies of scale to the market. It can actually make multiple acquirers coexist, can make multiple issuers coexist, and all of them can work absolutely seamlessly with each other. So that's a great model to aim for. But it's a thing which is a journey to reach there, and not something which can be done instantly. Now, because in this case, a merchant can be acquired by multiple different parties, and we see that happening in India. There is a standard, but two different competing acquirers can actually go and target a single merchant, primarily because that merchant has a large volume of transaction and they would want that to come to them. So both can go and acquire that particular merchant. From an overall market point of view, that's good because then each of those parties can then work a better deal for that merchant, and it overall improves the ecosystem. But in the shorter term, it means that there are two parties competing with each other for exactly that same merchant, which can lead to a lot of wasted efforts on that one. So that's the view on the regulation part of it. Now, if you take all of these three models of doing things, the mutual acceptance, aggregated and regulated. I think the regulated is kind of the end goal, but mutual acceptance can work great where there is just a couple of different parties, and aggregated is probably the one which will allow you to make this work in the most different context and still achieve a scalable solution, which actually can make for a good business proposition. So looking at all of these things, sorry, this is moving. Right. So, sorry. So, to summarize, and I think we are running close to the end of time. So, QR payments are a great solution. I think there's enough smartphone penetration in the right segments to enable that to happen in most places in Africa. They are a particularly effective technology. It's completely app-based, makes it extremely cost-effective and works well. Unified QR is the goal for all QR-based payments. And while regulated QR is the eventual end goal, and everybody should reach there eventually, aggregated QR is actually a perfect way to make a beginning in the short term and can lead to a actually perfectly viable business proposition in the near term. So with that, I close my talk and see if you have any questions. I'll be happy to answer those as those come up. Yeah, thank you very much.